Coming into the February reporting season, there was a bit of pessimism.
We knew coming into this half that it was going to be a challenging revenue environment.
The main pressures that we're seeing at the moment are a lot of domestic cost pressures.
We've seen fuel price 50% higher than what it was pre-COVID.
Add to that worries about surging interest rates, rising unemployment, and talk of a recession. But against this backdrop, Australian companies announced better than expected financial results.
40% of companies have beat expectations, 33% in line, and residual not performing up to expectations.
With consumers cutting back on spending, it's getting harder to make money, and you'd normally expect discretionary retailers to struggle.
They're probably the top performing sector just simply because things aren't as bad as people expect.
According to CommSec, 81% of companies on the ASX 200 made a profit, but that's the weakest result in nearly 4 years. And when you add up all their profits, the dollar amount has fallen by a steep 35%. But in the coming months, dividends of almost $34 billion will be paid to shareholders, which is just 2% lower than the same period last year.
The fact that many companies are prepared to continue to pay reasonable levels of dividends points to the health of the Australian economy.
The financial health of supermarkets like Woolworths is also solid, with its underlying half-year profit up 2.5%. But its share price has dropped 13% since the year began, as it's been embroiled in controversy over lack of competition.
I think going forward, it's going to be a lot more difficult for them to outperform, particularly given the government's view that they perhaps are taking a little bit more from the Australian consumer than they're entitled to.
Clearly, the exit of CEO of Woolworths also put pressure on the sector.
Insurance companies have been some of the biggest winners so far, with the likes of QBE announcing their full-year profit has more than doubled.
On the East Coast, you've got two very large brands, IAG and Suncorp, and their subsidiary brands that have a market share of almost 80-odd%.
So with very little competition, it's no wonder insurance premiums jumped 16% in 1 year.
A lot of companies are able to offset the rising costs by pushing up prices.
Meanwhile, falling commodity prices have been a problem for mining companies and their profits. Along with higher production costs, BHP is even thinking of shutting down its nickel division.
Small part of the business being nickel has seen market challenges in the past 12 months.
Looking ahead, whether the share market continues to rise will depend on the Reserve Bank.
If we do see cuts in interest rates, that'll be very positive and possibly see further highs into the market.
But markets could fall significantly if cost of living pressures don't subside quickly.
If inflation does remain elevated and companies aren't able to pass on their costs, we're likely to see perhaps some downgrades in the near term.
And of course, storm clouds overseas can have a major impact on the local share market.
The biggest risk will be geopolitical, as in whether there's trade war or there's other issues coming through the Middle East, and then there will be the US election.
And there's always the risk the economy could tip into recession.